It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. It's Jill on Money. Yes, indeed. Beautiful October. Lots going on. We are broadcasting live from the Capital One studios. Capital One, what's in your wallet? That's the question. Mark, I know it's not surprising to you. You know that I line up my dollar bills. They have to all face the same direction in descending order. Do you have your singles first? Yeah, that's what I do too. Also, my favorite new feature of the ATM is that some ATMs allow you to pick your denominations. I like that. I like having a couple of big bills, just, for certain purposes. I know. Mark's saying he's surprised. I always like having a little cash. I think it's because I'm old, but I like having a little cash on hand. I think that when you live in a city, sometimes it's a little bit, you feel like, I never need cash, right? Because everyone takes Apple Pay, or you can, use Venmo. You can do all that. But every so often you find you're like, I need some cash. So it's good to have. I just got back from a trip to Ireland, learned, by the way, where they don't often take credit cards in cabs, so I needed cash there. Also learned a lot about the impact of Brexit and what could be happening. Spoke to one restaurant owner who said, I know the Republic of Ireland is in the European Union, but all of my booze comes through London. And so she's freaking out. So even on that very micro level, you absolutely see the impact of this Brexit talk. All right, let's get to your talk. What's important to you? Let's find out. First up, we've got Dee on the line. She's calling from Seattle. How are you today?
I'm fabulous. And you today?
I'm great. What can I do for you, ma'am?
My husband and I, we have about $1 million in stocks in the S&P.
Mm-hmm.
We have $500 in a money market. We have $500,000 in a money market, $100,000 in CDs. We have about $1 million in real estate. And we have been talking to our financial consultant, and she has recommended to take the $500,000 from the money market and put it into a managed bond fund.
Mm-hmm.
We're pretty light in bonds. Mm-hmm. We realize that. It wasn't our intention to get into bonds, and now the market's just gone like all crazy.
Yeah. It's so, I like that. That's the absolute best way to describe it. The market's gone all crazy. So the $1 million in stocks, is that in individual stocks or is that in index funds? What's the nature of the stock position?
Some of it is individual stocks,
mm-hmm.
and some of it is in index funds.
Okay. And you guys manage that yourselves, or is this person, this financial consultant, does that person manage it for you?
So we manage all of our own individual stocks.
Okay.
And my husband has been using money from the $500,000 that's in the money market
mm-hmm.
to buy the stocks. And he is a huge believer in, oh, my God, this is the time to really look for some good deals out there.
Oh.
There's good deals left and right. There's got to be a few out here. Let's find them. But if we tie that money up into this managed bond fund,
mm-hmm.
that's not going to be available to us.
Yeah.
We're recently retired, both of us.
Yeah.
Early 60s. So it's not like, we can still be doing the 401k, 403b. Those are gone now. So mm-hmm. now it's figure it out.
So let me ask you a question, Dee. Okay. How are you guys supporting yourself?
We have a small business of which we make about $50,000 a year.
Mm-hmm.
And to be honest, we're probably not the world's best consumers.
Mm-hmm.
We're better savers than consumers.
That's okay. We love good savers. This is a program that loves a good saver. Is the $50,000 a year all you need to live on?
Well, we could probably do it on that, although it would be nice to have a little bit more than that. Mm-hmm. And neither one of us are drawing Social Security at this point in time either. So
when do you think you might want to draw Social Security? Because you are in your early 60s. So what's your full retirement age? 66, 7?
Probably about 67, 68. We've kind of been playing around with some of those numbers. The financial consultant says that, the rate we're going right now, we wouldn't even have to really worry too much about pulling anything.
Oh, that's good.
So, we're completely free to do whatever's going to work best for us.
So what is it about? I'm just intrigued because presumably what I think is happening here is that you've saved a bunch of money. You've got this small business. When you ever decide to take your retirement benefits from Social Security, that you've got plenty of money. You're not going to run out of money. So tell me about your husband's desire to find these great deals, and what is it that, since you don't spend a ton of money, do you want to leave a bunch of money to kids? Like what's the motivation?
I think that being children of Depression era parents, it was really important, especially to his family, to save, to work towards a future and a retirement. His mother passed early, and his father recently passed. So he just wants to make sure that we are secure no matter what happens. And we do have, 2 children and a grandchild at this point. So leaving it to them is not a problem to us. We are looking at, doing things for us, doing some traveling and da-da-da. But, it's just, we've never been these huge consumers.
Yeah, I get that. If you're not a huge consumer, I'm not particularly clear as to why your husband seems like he wants to, except for the fun of it, of getting in on it. And you've already got $1 million invested in the stock market. I think that's plenty, given your kind of where you stand. I don't think it's a terrible idea to actually have a good chunk in bonds. I don't know whether you need to be in a managed bond portfolio. I mean, you don't have state income tax in Washington State, correct?
No,
okay.
We don't
so
have
you
it.
don't have to worry about buying some individual bonds that are, essentially, tax free. You'd be buying some types of bonds, maybe some blended types of bonds. Why wouldn't you just buy? Even if you just said, let's take some of the money and start buying index bond fund. With a couple of different flavors of that and call it a day, which would cost you a fraction of what you would pay in a managed account. I think that might be more interesting. And I guess the other piece of this is that I am going to caution you about, that you don't really need to take on more risk. I would say to your husband, like, look, honey, we're in great shape. Why are we rocking the boat? All righty. That could be you. If you want to get on the program and ask us a question, just send an email. Ask Jill at JillOnMoney.com. And of course, subscribe to our sister broadcast. It's called Jill on Money. It's a podcast. You can get it on Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcast. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. And this is the program that takes the mystery out of your financial life. And one of the ways that we can help you is that we can bring you on the air with us and you can ask a question. I'm still a certified financial planner. Hey, I'm re-upped, Mark, officially. Paid my dues, took all my continuing ed. I am a certified financial planner still. Yes. And so I'm all done with that, which means I can actually answer many of your financial questions. Not all of them. I mean, I cannot know everything. I have a lot of good friends in the industry who can help me out. When I don't know something, I will tell you I don't know it. If you'd like to get on the air, send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. Or when you're on our website, which is coincidentally called Jill on Money, jillonmoney.com, there's a contact button in the upper right corner. That's all you have to do. Click, and then we'll get your email. And it could be about anything. Maybe it's a retirement question or an investing question, a college funding question, whatever it is, we'd be delighted to help you out. Always an honor that you think to use us to help you in your financial decision making. Let's go take another question right now. In fact, we've got Lisa, and she's on the line from New Jersey. Hi, Lisa.
Hey, Jill. Thanks for taking my call.
Sure.
I have an old 401k, still at an old employer, and I wanted to know what is the best thing to do. Should I leave it there? Should I roll it over to my current employer? Should I roll it over? We currently have other accounts at Fidelity. Should we roll it over into that?
Let me ask you a quick question. So
Sure.
First, start with old employer's 401k. Where is that plan held? What firm holds that?
Truthfully, I don't know.
Okay. You're working now. You've got a new 401k. Do you know what investment company, mutual fund company holds that 401k?
My current account is at Hewitt.
Hewitt. Oh, okay. Got it. I don't know what I think that I know kind of what that might look like inside and some of the choices, but my guess is it's not the cheapest plan that's out there. I've seen it before. The reason to stay in an old 401k is that you've got this great plan. Maybe it's a plan that is like, wow, it's at Vanguard and the choices are vast and they're so inexpensive and I've got tons and tons of index funds. That's one reason to keep it in the old place.
Okay.
Okay. To move it to a new plan, there's the advantage of consolidating and having everything tidy in one place, or the new plan is so much better than the old plan. Again, lots of choices, index funds, all of that. And then the third choice is to roll it over into an IRA rollover account. And maybe you would do that at Fidelity. You said you had other accounts. So do you have an IRA account there already?
I do.
Okay. So, you might want to consolidate it there. Look, I'm not the cheerleader for one of these companies versus another, but, we know that if you're in the Fidelity family, you've got a ton of different index funds from which to choose. It's very easy to do that, and you will consolidate. So all of that being said, I think that, not knowing a ton about the old plan, not thinking the new plan's so great, my inclination is to roll that to the IRA rollover account that is at Fidelity already. And then we get to the larger issue, which is, how am I going to invest it? How old are you, Lisa?
I'm 50.
Married, single?
Married.
Okay. And are you maxing out your 401k right now?
I'm doing 15%.
15%. Okay. And how are you guys doing just as a couple financially? Do you have kids? Are you paying for college? What's right now happening for you?
We have two kids, 12 and 14.
Oy, you're in it, baby.
Yes, we are. We'd like to help them out with college, but I don't mind if they have to have some skin in the game.
Mm-hmm. All right, good. And I don't mind, by the way, if they go to Rutgers. So let me just say that. Have you saved money for college?
Not a lot.
Okay.
We've been concentrating on 401k as well as an emergency fund.
Okay, great. Right now, if you look at your retirement assets between you and the spouse, how much total?
1.8.
Nice. And you got a house?
We have a house.
How much do you say it's worth?
It's probably worth $375,000, $400,000.
Mm-hmm.
And we have a $160,000 mortgage at 3.875.
Oh, sweet. That's great. And you said you've built up your emergency reserve, so you got a nice chunk of cash that's just in case. Good.
We have 90.
Okay. And any other debt besides the mortgage?
Nothing.
Beautiful. I love this. How much do you make together?
About $240.
Okay. I mean, you're in very good shape. I think that, have you ever actually run your retirement numbers?
I haven't. So
that's a fun thing to do.
We did have a CFP we met with a couple of times. He wasn't the best fit for us.
Mm-hmm.
We've kind of been looking for somebody else.
Mm-hmm.
But, pulling a name up on a website,
I got you.
It's a little disconcerting.
I hear you. It's nerve-wracking. We can help you out with that, first of all. So if you want an actual planner to help crunch numbers and look at retirement, look at college, Make sure you've got the right health, life, disability. Make sure all the insurance stuff is done. Make sure that your estate planning is in place, that you want like a real plan. I'm sure that we can get you a few names. And I think that what's really interesting is that oftentimes people will have this kind of situation and they'll say, all my money's in retirement accounts. I don't need a plan. Well, wait a minute. Maybe you do. Because you really want a plan. You don't necessarily need someone to manage your money. You just want to know, like, what's the game plan, right?
Right. And in the future, we would like to have some investments outside of our retirement plan.
Mm-hmm. Yeah, I mean, that totally makes sense. I have the perfect person for you. I'm going to tell you what. I'm going to have Mark put you on hold, and he's going to give you this person's name and literally in your neighborhood. I think it's a great idea for you guys. At this point, you got a chunk of money that is set aside for retirement. You're making good money. I think the big questions that you have about allocating your money is really in line with your risk tolerance, but also trying to figure out what makes sense in terms of how much should we be saving for education? Should we be saving for education? Should we just pay this out of cash flow? And, just getting a bigger picture idea. I love that idea.
And then speaking about, like, what is an appropriate fee? Because the guy we met with charged an hourly fee, we don't really have any investments outside of our retirement, so we can charge a percentage.
Mm-hmm.
So
what was the hourly fee that you were quoted?
I think at the time he was charging us $2.50 an hour.
That's not bad. I think that's probably in line, but I do also think that there are plenty of people who will say, I will do a plan for you instead of an hourly, pay me $3,000 and I'll do a financial plan. I don't know what that is, but I'm just saying that I think there's plenty of people who will give you, I like a flat fee myself rather than hourly.
Okay.
I don't know. I think hourly is always like, oh, are you calling me because you want to talk to me or you want to talk, I want to know what the fee is.
I found this guy also liked to chat a lot about himself.
Yeah.
And then he also told us that given our age, we would probably need to work until we were 70.
That's interesting.
Given our, generation.
I don't know about that. I mean, maybe. It depends what you want. Like if you said, you know what we're going to do when, well, first of all, your kids are young. So, you're kind of screwed anyway. You're probably going to work for at least, let's say 15 years to, 60s till 12-year-old gets through college, right? And presuming you like what you do, then like rock on, keep doing it, right? But if you're like, I want to do something else, then I'm so like bought in on this idea of like the next career, in your 50s, 60s, 70s, because I do think that there is something to be said for people who remain engaged in the work world. I'm not saying you have to work as hard as you work, but being able to do something and have a place to go, I think it's fantastic. So, I mean, I think
a second career would be great.
Yeah, and I think that really has a lot to do with how you communicate what your goals are to a financial planner. I mean, that's really the issue. So if that's something that you're like, oh, my God, that turns my stomach, I don't want to do that, then the planner should be able to say, okay, well, here's plan B. And here's plan C, and here's plan D.
Right.
Here's what we're going to do. Mark is going to give you some info. Hang on 1 second, and we will absolutely, positively help you out. And I wish you the very best of luck. And again, I'm just going to say this, Rutgers.
Well, I'm a state school girl myself.
There you go. Perfect. Okay, we'll get back to more of your questions. Remember, you can go to JillOnMoney.com. That's our website. And there you can sign up for our free weekly newsletter. And if you've got a question while you're poking around, click the contact button and we'll get your question right away. Okay, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. We are the program that tries to help you get where you want to go. Think of us as like your friendly trainer at the gym. Every so often we've got to kick your tush, but we're mostly here to help you. And, you've got to do some of the work, really most of the work, but we'll help you and guide you. That's really our job. If you've got a financial question, anything, really, about anything going on in your financial life, anything with a dollar sign, send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. So this is a follow-up email from Jim who just wanted to clarify. And he says, I recently received a $130,000 balloon payment on a property I have sold. I live paycheck to paycheck and I have a very small amount for emergencies. I'm afraid to invest it with the state of the economy and maybe a looming recession. I am worried about buying high and selling low. Been there, done that. And he actually wrote in a follow-up that he wanted me to understand that he wants to do something for the short term and invest if the market tanks so he can invest low. He hopes to retire in 7 years. And so here's the deal, Jim. This is classic market timing. And as anyone who has read my book knows, I tried to do that once. I tried to time the market, and it just doesn't work. It is nearly impossible to buy low and sell high, mostly because you've got to make two perfect decisions. So let's start with you. When you say you're living paycheck to paycheck, the first thing I'd love for you to do out of the $130,000, set aside that emergency reserve fund and make it sacrosanct. Just really think of it as this is the emergency reserve. And what is the amount that should be in that emergency reserve fund? Well, I'd love for you to take a look at what your expenses are and put at least 6 months of your expenses in that emergency reserve, and probably a year's worth. Because maybe if you're living paycheck to paycheck, you need to have a little bit of a bigger cushion, because if something bad happened, you couldn't do anything about it. Now, I don't know how much that is, but I'm going to make it up. Let's pretend that you've got to put $30,000 a year. Maybe you spend 30 grand, or maybe you spend 40 grand, whatever it is. Put that away. Don't touch it. Now, for the rest of the money, there is no short term. There is no buying high, buying low, selling high, selling low. There is a strategy. So whatever the rest of the money is going to be used for, it should not be treated as something where you could figure out the perfect moment to enter or leave a market. So maybe that means that, let's just say there's $100,000, that you are going to be a balanced investor. Some money in risky stuff, maybe that's some stocks, maybe that's some commodities, maybe it's a little real estate investment trust, but some riskier stuff, and the other half in less risky stuff like fixed income, very boring. But in essence, it's like any other money, because even though you're going to retire in 7 years, I don't know, maybe you don't need all that money in 7 years. And if you are going to retire in 7 years, my question is also, how does your retirement income look for you? You will maybe receive a pension, maybe Social Security. We need a little bit more information, but my main point here is to remind you that please, please, please don't try to pick the best entry point or exit point. Market timing over the long term just doesn't work. Okay, question from Scott about life insurance. Well, Scott, you've missed your window of opportunity. September was Life Insurance Awareness Month. Just kidding. I'll do it. Scott's 50, his wife's 47. They've got two $500,000 20-year policies, and the term of those policy is up in 6 years. And, he says this only costs $75 a month. Now, here's the question. Our mortgage will be paid off in 15 years. Our kids will complete college in 10 years. It appears to make sense for us to be insured another 15 years, perhaps even 20. My thought is to cancel our current insurance and start 2 new policies, $1 million each, which would likely cost a total of $250 a month. Does this seem like a good approach, or would you recommend another strategy? Let's go back. Scott, it might be interesting for us to know, what are your assets? Because when you bought those $500,000 policies 15 years ago, you probably didn't have a lot of money saved. So my question is, do you have other assets? Maybe you actually don't need insurance. I'm not saying you don't. I'm just saying maybe you don't. Because if in 6 years you have enough money that is saved to actually be able to take care of all the needs necessary, then maybe you don't need it. So we need more information. I'd love to follow up with you. My it does become fairly expensive, as you're seeing, $3,000 a year to buy term policy. A term policy, in the future. So I'd be interested to know exactly how much insurance you need. You know who's got a really good insurance needs calculator is the American Institute of CPAs, the AICPA. They've got a lot of calculators. If you look at the life insurance calculator, it's pretty good. I like it. But if you want to follow up and just tell us, how much money have you saved? What are your asset levels? What do you need? Then we might be able to do that analysis with you. So I can't recommend another strategy until we know those answers to those questions. Okay. 1 minute, Mark says. Can I do this fast? Okay. This is from Shirley. She and her husband are in their early 80s. They've got IRAs. And she's basically saying, she wants to invest, and she wants to basically start investing with Vanguard. I like Vanguard. It's a really easy way to invest. And so, Shirley, I really have the highest regard for these companies that offer straightforward, low-cost investing. Index funds, don't go crazy. Individual, the individual sector funds you can stay away from. Make it big, make it broad, and make it safe. Okay? Thanks for writing. So it's Jill on Money, and we are so happy that you're listening to us. During the break, why don't you go onto our website? It's called JillOnMoney.com. There you can read all the stuff that we write. You can listen to old shows. You can watch my TV segments. Check it out, JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back. It's Jill on Money, and we are delighted you're joining us. Hey, have you followed us on social media? Mark is very busy on social media. Mark, since you kind of took over and made sure that I don't see nasty things, my life is much improved. I know. He has to see it. But then he tells me if something's important. Like, oh, your uncle's trying to reach you on Facebook. The one thing I miss is birthdays. That's the only downside of not being on Facebook so actively. Mark, can you tell me when my friends have birthdays? Okay, great. All right. Okay. This is a very interesting email. If you would like to make comments or if you'd like to ask us a question, just send us an email. Ask Jill at JillOnMoney.com. Julie writes, my adult son and daughter-in-law take Florida trips, girls and guy weekends. Nothing is spared for our grandchildren's activities and clothes. New cars and a nice home to live in. Social network reveals all the fun things they do. We don't see them much as they are way too busy. We only live a few hours away, but then I get a phone call when they need money to cover bills. My husband and I are retired. We never did the things they do when we were young, or do those things now. I guess it upset me, and I said no. Well, now we are excluded and no phone calls to check on us. What's your thoughts on this? Mark, would you like to offer your thoughts on this before I do? Julie, it's a terrible story, and I never want to hear about people feeling excluded, shunned, disowned by family members. So that said, do we really have to have this fall apart over money? It sounds like there is a problem. It sounds like your kids might have a problem in terms of how they spend. And I guess one question would be, did you previously offer to pay, or had you set up a pattern where you did pay and now you're changing the rules? What was your relationship like before? And, I hesitate to say this, but it just makes me so sad to think you've lost a relationship over, is it money? Usually money is just the easiest way to express problems in a relationship. So here's what I think. I think I'd love for you guys to just come back together somehow, some way, and talk very frankly about your feelings. Now, if they've just completely iced you out, what are you going to do? But I don't know. This one makes me sad, Mark. All right, by the way, just let me give you the roll of the eye that just came through the window pane. You're rolling your eye at the kids. Look, Julie's writing us, so we're immediately taking her side. But there are two sides to the story. He's not buying it. Anyway, go get a shrink. Go come back together. Come on. It's your family. All right, Sue writes, what is the source of the money you can put in a Roth IRA? Is it true you have to leave it in there for 5 years before you can use it? Also, is it possible the government will tax the interest earned down the road in the Roth? Since it is in an IRA, it seems like the whole amount could be taxed when withdrawn again. What is the advantage moving money from a traditional to a Roth? Thank you. I enjoy your show. Sue in the Bay Area. Okay, so yeah, you can always take what you put into a Roth out, okay? You can take your cost basis out. It's already been taxed. You can't take the accumulation out for 5 years. That's number one. The source of the funds can be anything, but you have to have earned income or be the spouse of someone who has earned income to use a Roth. And the other piece of it, when you ask, could this be taxed down the road? I doubt it, because most of the changes in tax law grandfather in assets that had one type of tax status previously. So I don't think so. The big advantage of having a Roth versus a traditional, Sue, is that the money's already been taxed, so that when you pull the money out down the line, there's no tax due. So obviously the money you put in, it's an after-tax dollar. All that accumulation grows without any taxation. That's the benefit. So if Mark will, don't we have our Roth? We have a big Roth IRA article, don't we? Have the traditional versus Roth. So go to the website, JillOnMoney.com, click on read, and you'll see that I have that Roth article there. It's probably from the summerish, I think. Okay, so check that out. Donald writes, transfer profit from 401k to brokerage account Roth IRA. Can I do this tax-free? I'm over 59 and a half. Or should I open an IRA with my principal 401k? Please advise. I love your radio show. Donald, you cannot. All right, let's start here. When you have a traditional 401k, the money you put in has not been taxed yet. So there's no pulling money out of that account, transferring money out of that account without paying taxes. That's the deal. So whatever you do, you're going to have to pay taxes. So you can open up a Roth IRA. You can do that. But if you have a principal 401k, it's a 401k. So unless you have a Roth 401k option, you're stuck with that 401k. If you are over 59 and a half, all you're doing is able to take money out without a penalty. You still have to pay taxes no matter what you do with the proceeds. Okay? All right. If you got a follow-up question, let me know. And if you listening have a question, give us a holler. Email us. Ask Jill at JillOnMoney.com or go to the website, JillOnMoney.com. While you're there poking around, why don't you buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. We'll be right back. You're back. It's Jill on Money, and we are broadcasting live from the Capital One studios. Capital One, what's in your wallet? They don't even tell me to say that, but isn't that what their slogan is? Oh, brother. I think I can say it. Okay, before we go to a break, finish up the hour, here's a question from John about the use of a revocable trust versus a transfer on death account. Which is the smartest to use, asks John. This account that he has stocks and mutual funds worth about $500,000. 2 parents, 6 adult children. I'm interested in knowing the hazards, concerns, and benefits. Why do you need a revocable trust? I mean, you could. Okay, so generally speaking, I like if you're going to do a transfer on death account is usually just a banking account, and I don't know if you need to do it for an investment account, but the revocable trust has more power and it has more discretion on your part. My question to you is, why do you need it? Do you have a huge estate? Do you hate one of your adult children's spouses? Do you want, some of this is really a question for an estate attorney in that, do you really need the firepower of a revocable trust? You may not. Maybe just leave it to them in a will. I don't know. I tend to like if you're going to go through it, I'd rather do a revocable trust probably, because if you're worried about something, that revocable trust, which is changeable during your life, becomes irrevocable, not changeable upon death. That's a more ironclad way of making sure your wishes are known. Okay, Jack says, I want to sell my house in Illinois, relocate to Florida. Does it make sense to withdraw money from an IRA account to help fund the new house? I need about $100,000 extra to buy the house we want in Florida after the sale of current home. Jack, don't you realize you're supposed to be downsizing, not upsizing? It really depends how much money you have. If you've got, $4 million and you're pulling out $100,000, sure. But if you only have a certain amount of money and you're burning through a lot of that liquidity to pay for the home, no, I would not do that. Okay? You're listening to Jill on Money. During the break, why don't you do this? Hop onto the website, jillonmoney.com, bookmark it, and while you're there, sign up for our free weekly newsletter. It's free, and it comes out every week. It's Jill on Money. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You are back. It's hour number 2 of the Jill on Money show. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Go to policygenius.com. Well, we got a great one this hour, boy. Woof! Jean Chatzky. She almost needs no introduction. You know her. She's from the Today Show. She's been on Oprah, MSNBC, CNN, The View, The Talk. She's got a podcast called HerMoney. And she's written like 1,000 books. Her newest book is called Women with Money: The Judgment-Free Guide to Creating the Joyful, Less Stressed, Purposeful, and yes, rich life you deserve. And I've met Jean a couple times. It was so much fun to have her in the studio, so check it out. Here is our interview with Jean Chatzky. Now, why write a book just for women? Because men like you too, Jean.
I hope so.
They do.
I wrote this book because things are changing for women very quickly in terms of the amount of money coming our way. The biggest shift is that women will inherit twice. We'll inherit from our parents, and we'll inherit from the husbands that we outlive.
Now, do you still think we're going to inherit from our parents if all these parents are basically blowing through their retirement nest eggs?
I think we...
Because we get a house?
Yeah, there's a house. There are some assets that won't get spent. I think overall we will still inherit. It's not a smart move necessarily to plan on it because it could come 20 years later than you anticipated. But I think the money's still coming our way. And we are getting educated at a much faster rate at men. Eventually, the salary gap is going to close. We're starting a lot of businesses. We just are getting more money. That is a really, really good thing. But we want different things from our money than men want. And we also like to learn about it in a different environment. I go around, as I know you do, and speak a lot. And the difference between a Q&A when I've got only women in the room and a Q&A when it's mixed is enormous.
Okay, let's go there. How different is it? You're holding these. What are you doing? You're holding these sessions.
So that's actually, I was talking about sort of the bigger speeches, but I'm holding these HerMoney happy hours HerMoney is my podcast and my website, and we've just been crowdsourcing these groups of women when I travel and saying, come, talk about money, have a glass of wine, let's sit, let's talk about money. I developed this card game, essentially. Pass around the cards, everybody takes one, and you have to start talking. And it is a judgment-free zone. It is incredibly special, I think, the way women just open up to these women that they haven't met before, of a variety of ages and stages, and share. And by the time I leave, they are exchanging numbers to meet without me.
That's so cool.
Yeah, it's amazing.
So what is it that you think makes the addition of men in the environment different for the woman? What is it that she's carrying in that feels guarded, maybe?
I think all of a sudden it's no longer a judgment-free zone, or at least we don't perceive it that way. I think we feel like we're not doing it right, and somebody's going to look at us and say, ugh, you're not doing it right, even though we do it right. Like, you've seen all the research. The research shows we're great at this, but we don't have the confidence to acknowledge that and to embrace that. And we still have this incredible bias towards safety and security that holds us back.
What is that? Where do you think that comes from? That when you say to somebody, what does money mean? Many times women will say security.
Yeah.
Why do you think that is?
I said, what do you want from your money, to every woman that I interviewed for this book? Safety, security, stability, savings, money in the bank. I think it is this need that we have to satisfy before we can take on anything else. I think it's biological. I think it's very much back to our caveman, cavewoman roots. I think it's emotional. Money is incredibly emotional. And I also think women don't feel safe in the world. But even more basic than that, I focused in on this Gallup study of how safe people feel walking home at night. And women don't feel safe.
Anywhere.
Even in developed countries, even in the best neighborhoods, they segregated the research and took the top 1/5 of women in terms of wealth, still not safe.
That's sort of daunting. Although I never feel safe anyway, and I just thought that was just being Jewish.
Well, it might be Jew. I mean, I agree with you, and it's like your mother sitting on your head and saying, look both ways before you cross the street. Look where you're going. And so we compensate, and we compensate with money. And the irony of all of that compensation is that it actually sabotages our financial security.
And how does it do that?
We keep far too much cash in the bank.
I love my cash in the bank.
So do I. So do I. And when I got divorced, I mean, look, all of this interviewing that I did made me take a really hard look at my own life. And what I realized was that I am typical, and nobody likes to be typical. But I have, at times in my life, and especially after that divorce, left far too much cash in the bank. I was intent on buying a home because I didn't ever want to have to move again, even though it was 2005. And if I sold my home today, I would not get what I paid for it. I mean, how awful is that? And it's fine. I got a lot of use out of it.
Yeah.
I drive a Volvo wagon. Like, if you want to be typical and worried about safety, you drive a Volvo wagon, and I am not giving it up.
Okay, and nor do you have to. So what does money mean for you?
It means, at a very basic level, it means safety, it means security, but it also means choices about how to spend my time, about what I don't want to do. It also allows me to support the causes that I want to support, to try to make the world into the world I want it to be, whether I do that through investing or whether I do it through giving more money away. That's become a more important goal for me.
So when you look at the lens of investment services and you see maybe some of these services that are pointed towards women, what's your reaction to that? You see Sally Krawcheck opens up a robo and calls it Elvest or whatever it is. What's your opinion about that?
I think if it works for you, if it gets you engaged, if that's what it takes to bring you in, okay. I do think women should take the fact that we're going to live an average 5 years longer than men into our considerations, and Sally's model definitely does that. I think you can also do it yourself. Whatever it takes to get you to step up. Step up. You don't want to listen to me. You want to listen to Jill instead. You want to listen to Susie or Sally. I don't care. But listen to somebody and do the right thing.
Okay, we'll get back to our interview with Jean Chatzky in just a minute. Hey, during the break, why don't you hop onto our website, JillOnMoney.com. You can sign up for our free weekly newsletter. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. If you have a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. Our guest this hour is the iconic Jean Chatzky. She's NBC Today's financial expert. She's a best-selling author. And she's talking about her new book, Women with Money. And she probably started her career speaking to women who are now retiring, but now she's actually talking to younger women, maybe children of those women. And, she notes that a lot of women tend to be conflicted and uncertain when it comes to our personal finances. And what's interesting to hear is what's going on with the next generation of women, our millennials coming up and beyond that, Gen Z. Hopefully they have a more, even-keeled relationship with their money. Let's hear it from Jean because she's talking to these people all the time. Here's more of our interview with Jean Chatzky. How do you feel the next gen is doing? You and I are about the same age, and we came up through, you in journalism and then financial services, and me in financial services and then journalism in very male-dominated fields. Do you think that there has been progress with younger women and their ability to kind of grab hold of their financial lives?
More than us, but I think that they have been forced into it. I think when you are sitting under a mountain of student loan debt, it absolutely forces you to pay attention in a way that people who don't have it can just slide for almost a decade. And I feel, it's an incredible burden for these kids who are coming out with a mountain of debt and having to learn to deal with it and having to figure out things that they should have been helped to figure out before they took it on, about how much they have to earn to actually comfortably repay that debt. And maybe they would have made a different college decision about going somewhere that would have been a greater value. But I do think in terms of saving, I think the millennials are doing great, and Gen Z is following suit. In terms of investing, not so sure.
I feel bad because they have these many hurdles, not just the student loan debt crisis, but you graduate or you watch your family suffer during the financial crisis, right? And it's very daunting, and to have those scars from your childhood or your teens, or some of them who said I graduated and thought I was going to just have any job available and it wasn't there for me. So how do you advise the younger generation? What are your initial steps that you outline in the book or in your life? What do you think as best practices for younger women trying to take hold and control of their money
younger people, actually, because I've gone through this with my kids. I've got a 25-year-old son.
Hard to believe.
Thank you.
Unbelievable. She had the child when she was 10.
And a 22-year-old daughter, and he came out of school and he got a job that had no benefits, like so many people these days. And I said, you got to open a Roth. You got to open a Roth. You got to open a Roth. And he was doing really well. I have a linked savings account with his. He hasn't kicked me off yet. I hope that he won't, but I'm sure that day is coming. And so I would watch him save and spend, and he was doing great, and he had the bandwidth. But he wanted to hold on to that savings because he wasn't, what if I want to take a trip? What if I said, okay, you're doing fine. You can do this. You can start small. How much do you think that you could contribute a month? $50? $100? I can do more than that. And he started with $250. He is continuing to ratchet that up. He actually came back and said, I should have done this a year ago. Because the thing that people who are a little bit afraid of investing don't understand is how much fun it is to watch your money add up. When you set it and forget it, when you just put it on automatic pilot and you then visit your account, even if it's lost a little bit over the course of the month because the market has gone in the other direction, the fact that you're continuing to contribute means it's probably kept you close to whole. And you feel good, and then you feel confident, and then you want to do more. And that's what I tell young women. Just start. I know you're not feeling good about this. I felt pretty awful the first time I went to yoga class, right? So I sat in the back, and the teacher, who I love because she makes fun of people, made fun of me. And I got better over time. But you kind of have to be in it to experience it and to progress and to gain that confidence. I'm still the worst person in the class, but
why are you all judgy?
Because
come on now.
I can't touch
Back
my
off.
toes.
Back off. Come on.
But it's okay. It's okay.
All right. So if you are getting the younger women at the earlier stages, and they are more in control, hopefully. Let's talk a little bit more towards the 30s and 40s. These women are confronting so many obstacles, and they're really, I think, feeling just sort of overwhelmed by their family lives.
Yep.
So how can someone in their 30s or 40s, who has like a controlling spouse who's kind of like, they've outsourced their money to the spouse.
That happens a lot.
Right? Like, you're better at money than I am, honey, you do it. What should those people be thinking about?
The first thing they should be thinking about is, do I know the lay of the land? If something happened, let's not even make it a worst case scenario. Let's just make it a travel nightmare. Your spouse is in Europe. They are stuck because there's a bad storm. They can't come home. The mortgage has to be paid, and you have to do it because the computers are down or something. Right. I don't know. Could you do it? Could you sign on to those accounts and actually do it? And if the answer is no, you don't know the passwords, you don't know where things are, that's really bad. Because what you don't want is for somebody to get really sick or die and you have to take it over and not know how. The second thing I would say is that if you're staying home and you don't have an IRA of your own, you're missing a big tax-saving opportunity. You should have one. And the nice thing about retirement accounts is you can't share them. They're yours and you got to manage it. And we know that when people have accounts of their own, they are more likely to step in and manage it. And you can do it the easy way. I grew up at Smart Money magazine, owned by Dow Jones and the Hearst Corporation. There are restrictions on what you're allowed to do trading-wise. I mean, that turned me into a passive investor, but I've never gone back. I've always been that. And passive investing is the way that most of us as individual investors should be doing it. We leave the fees low. We leave our fingers out of things. We set an asset allocation and we forget it. One of the things that I did in these HerMoney happy hours was ask the question, are you an investor? And very sheepishly, like 2 or 3 hands would go up. And then I'd say, do you have a 401k? And every hand would go up. And we have a misunderstanding of what it means to be an investor. Women think investors look like and sound like Jim Cramer. They think they're traders. And that is not how to invest for your long-term financial life.
Why has the industry continues to try to lure people in with, like, there's a man behind the curtain
Right.
that can beat the market?
Fees, right? It's fees. I mean, active investing makes more money in many cases. And that is something that we just have to acknowledge. There are also a cohort of people, generally men, who like to win. You know, they want to beat the benchmarks. They take pride in, well, my portfolio is doing better than the S&P, and that takes an active investment stance. You can't just buy the S&P and expect to beat the S&P. It's not going to happen. You know, I argue, if you look historically at how these indexes have done since the beginning of investment time, I'm fine with that.
Okay, we'll get back to our interview with Jean Chatzky in just a minute. During the break, here's what I think you should do. You should subscribe to our podcast. It's called Jill on Money. You can get it on Apple, Stitcher, Radio.com, Google Play, or just hop onto our website, JillOnMoney.com. You'll find everything there. All right, we'll be right back.
(401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. And we've got a special guest this hour, Jean Chatzky, great author. Now, I think business owner in her own right. She has her own company called HerMoney Media. And she's really built a career on helping people understand their financial lives. In this, the last part of our interview, we're going to talk about the things that will, or the habits, the traits that can make you a better investor. And you know what? The book is called Women with Money, but it's for everybody, okay? Anyone can benefit from this. Here's the rest of our interview with Jean Chatzky.
So in the book, I lay out the 3 components of being a successful investor, right? So one is saving. I heard once, and I have stolen this phrase, that you can't, just like you can't out-exercise a bad diet, you can't out-invest a savings problem. Savings are the base, and you got to put enough money in there to grow, or you're not gonna be successful.
Number 1, savings. It's the Chatzky method, TM.
Number 2, asset allocation. Right? We've all seen, you've certainly seen, I don't know if your listeners have all seen, but there are years of studies that point to the fact that asset allocation is responsible for 80 to 100% of the success of your portfolio. And it's sort of, the first study put it at 90, the second study sort of revised to say 80 to 100. Either way, it's the
Let's
lion's
say 80.
share.
It's like, that's where you're going.
Yeah. Third thing is security selection. You don't have to do it at all. Just buy the markets.
And obviously all the index funds out there are pretty much hurtling towards zero in terms of cost.
Right.
So that's an interesting place to kind of talk about the industry in general. Here we are in 2019 where we do not have a fiduciary standard for the entire industry. So what's your view on what should be happening with financial advice givers?
So I'm all 100% in favor of a fiduciary standard. Doesn't look like we're getting one under this administration. But I think that individuals, when we interview financial planners, should be asking that question. You know, are you a fiduciary? What standard do you adhere to? Or in English, do you invest with my best interests at heart at all times? Do you make decisions with my best interests at heart? And there are enough who are fiduciaries that you can find one of those.
Yeah, and at all times, because remember the old CFP rules, which are changing at the end of this year, said you have to be a fiduciary during the planning,
right,
but not during the sale. So fiduciary at all times. Am I always first? What do you do with if you have someone's listening and they're like, well, I have an advisor who I now have found out it's not a fiduciary. Should I fire that person?
Not necessarily.
What should I ask him besides the fiduciary part?
I would go back and I would make sure you understand the fees. You want to dig into, and by the way, you should do this anyway. You should dig into the various investments. If somebody is investing on your behalf, if you're not a DIYer, you want to know, what is this costing? And are there alternatives that cost less that could be substituted? And why didn't you buy those instead? What's going on that you chose this over that when the returns are equal and the costs are lower? Because women in particular, we are really big on control. Control makes us happy, but I think that's true for humans. Fees are controllable. I can't control the markets. I can't control inflation. I can't control taxes. I can control fees.
What do you think is the most misunderstood, or let's do threes, because I love threes, the misconceptions that many of the women that you encounter who listen to your podcast or come to these meetings, what do you think are some of the misconceptions about advice givers that they have? Besides, let's say, put it aside that they think the guy or gal is a CPA or a lawyer working in your best interest. What other misconceptions do you think they have?
I think there's a big misconception that they're all the same. People come to financial planning from a variety of backgrounds. Some are accountants, as you said. Some are insurance people. Some are trained as CFPs. You got to know where they're coming from in order to filter the advice that they're giving you, because it will have that sort of bent and bias. There's a big misconception that somebody who is advising you about your investments is looking at your life. I like holistic investors. I like somebody who's looking at my big goals. I think people feel like you have to have a lot of money to work with an advisor. That's my third one. What I like most about the financial planning industry right now is that people are shaking things up. They are opening facilities where you can come every single month and you can have a discussion with a coach. They are charging by the hour if you don't want to hire somebody who is going to manage your money and take a percentage of your assets. There are a lot of different ways to do it these days, and if what you want is a little short-term therapy, you can find that.
How do you feel about the advent of these online platforms, these robos? Do you think that that's a good way for people to basically try to consolidate their financial lives and get a snapshot? Or do you think that some of these people are going to be a little bit unnerved the first time we go into a real bear market?
I think the robos have taken some important steps to account for the fact that they can see coming that people are going to get unnerved when we go into a real bear market. I mean, I've been watching how they've added human beings back into the equation, and I think that's a really good move, because sometimes you really just want to talk to somebody, even if it's just to say, we're watching, things are okay. But I have an advisor, and I like the phone call when things are going, a little bit sideways. And I like being able to pick up the phone. My husband and I are looking at buying an apartment, and I'm talking through, we look at my income and we're projecting this out, and if it stays like this, and can we buy the bigger apartment? I do this for a living, and I want to have people to bounce this off of.
Thanks so much to Jean Chatzky for joining us. You can go get her book, Women with Money, anytime. And if you've got a financial question, we would love to hear from you. Ask Jill at jillonmoney.com. That is our email address. Give us a holler, and we'll try to help you out. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and sometimes you send us emails, and I ask you for more information. Well, here is a great case where Maria followed up. So she had written us a while back that she was a 40-something-year-old person. She's really on her own, and she's got a bunch of student loans, $60,000 in student loan debt, 27 grand that's unpaid. She also has $10,000 in credit card debt. And she said she's scared. And I followed up, I said, well, tell me more about what's going on for you. So here's what she says. And by the way, don't get too excited, but when you send us an email, what we do is we send you the audio clip so you can hear it. So she writes, thanks for sending me the audio. This is the coolest way anyone's ever replied to me. Regarding your question, I make $170,000 a year. So she's 41 years old, making good money. She says, I have $50,000 worth of my company's stock. And she gets a 401k match. She says, I'm thinking about buying a small apartment. So tax and maintenance costs don't drain my savings. But given the change in mortgage policies, I'm not sure if this is good. How do I decide budget for buying a house? Lots of calculators. All right, first things first. If you've got $50,000 of stock, the first thing I would do is I would sell it and I would pay down my outstanding student loan balance and my credit card balance. Boom, you're done. Isn't that easy? And now just put the rest of it in a savings. That's your emergency reserve fund. Okay, get that done, get it out, and now you can really focus on what you need to do. So you pay that debt off. You sell the stock. You put aside any money you might need for taxes. So make sure you know what that number is. You pay off the debt, and now without that debt, you can start putting as much as you possibly can into your 401k. So what you want to do is you want to put $19,000 into your 401k. And I would not go and buy anything right now. I think just doing what you do and keeping your financial obligations limited, that's what I would do. Okay? So you're going to be fine. Do that. If you have a question, just let us know. Okay. All right. So this is a note from Jillian. And, some people think my name is Jillian. Not. Just Jill. FYI. Okay. So Jillian's from New Jersey. My husband and I listen to your show together. We often discuss it. Here's my question. I retired 3 years ago at age 68, and I waited to take my Social Security until I was 70. About 3 months after I retired, I was asked to return 1 day a week to help out in a different department. I was glad to do it. I earn about $8,000 a year from this job, none of which I need to live on. It is now just being deposited into the bank account. Here's my question. Am I eligible to make a Roth contribution? Yes, you are. How much can you contribute each year? You're going to love this. $7,000. $6,000 is if you're below the age of 50, an extra $1,000 because you're over the age of 50. So that's kind of cool. If I can use a Roth, can I have my paycheck direct deposited into my bank account and then put the money into the Roth myself? Yes, of course. This is a great question. Thank you so much. We love you. I even bought your book as a birthday present for my husband. Jill from New Jersey. Aren't you sweet? I'm so happy. Thank you. And go out and open a nice, cheap Roth IRA with some no-load mutual fund company, Vanguard or T. Rowe Price or Schwab or Fidelity or TD Ameritrade, just something cheap, okay? Okay, Brian. Brian's dad's 88. He's getting remarried after losing my mom about 5 years ago. His bride-to-be is 80. The question, should she wear white? No, that's not the question. I'm kidding. The question, would it be better? Would it be better? I can't see which is. Oh, I see. Would it be better for them to just do vows and not get legally married for financial reasons? Probably doesn't make a huge difference. I don't know. But, first of all, I'd hate for you to have that conversation with your dad because I think that's wildly uncomfortable for you. You can ask an accountant to do a dummy tax return side by side as two individuals. And this is actually a good time of year to do it because they're not so busy. So I would absolutely try to talk to an accountant if they care about it. But if they don't care about it, guess what? Don't get involved. Okay. This is Maria, who says, you mentioned the problem with the FIRE movement, that one problem with the FIRE movement is health insurance. I want to share my personal answer. Getting the hell out of the U.S. There are two ways to do this: as a nomad or by attaining legal residency in another country. Medical emergencies are far more affordable in other countries. I've been living in Mexico for almost 2 years with temporary residency. Despite the delicious food and wonderful people, I don't recommend moving here. My next move will be as a digital nomad in South America, hoping this ignites a spark with some of your listeners who might never have thought of this idea. It's amazing. The big problem for me would be like, how am I going to go see my mother? Like most of us just can't leave the country like that. So, especially those of us with Jewish mothers, aging Jewish mothers, and other types of mothers. Okay, it's Jill on Money. If you've got a financial question, we'd love to hear from you. Ask Jill at jillonmoney.com. And you can always go to the website, and there you will find all sorts of fun things, including our sister podcast. So you can subscribe to it anywhere you get your favorite podcast, radio.com, Google Play, Apple, Stitcher, wherever. Check it out. Jill on Money. It's the podcast version. Okay, we'll be right back. You're back. It's Jill on Money. We are broadcasting live from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Okay, got a question from Brenda, who says, my partner and I would like to set up an education plan for our 10-year-old grandson. He lives in Oregon. We live in Oregon. He lives in Washington. Any suggestions you have might be appreciated. I went on to the old savingforcollege.com website because it's just easy to kind of get some information there. So here's interesting information. So let's talk about Oregon because that's where you live. It doesn't really matter where the kid lives. Contributions to an Oregon 529 plan could actually be deductible in terms of Oregon state income tax. So we know that when you put money into a 529 plan, you put an after-tax dollar in, and it grows without taxation as long as the kid uses the money for college. But in the Oregon plan, if you've got so any contributions up to $2,435 by an individual, so that would be you and your partner can individually both do this, those contributions are deductible in computing Oregon taxable income. That's kind of cool, right? And so I would suggest that you take a look at least the Oregon plan because it's so much better to get that beautiful tax deduction. I would absolutely check that out. Okay, so check that out, and you can go to savingforcollege.com. I think that might be your best bet. So give it a shot, and we'll figure out where you need to go. All right, that's it. That is the program. Thank you so much for listening. It has been a delight. If you missed any part of this show, or you want to go back and listen to other shows, just go to our website, jillonmoney.com. And don't forget, we also have that podcast. You want to check that out. We put great stuff up out on social media. Mark does all the hard work. So, as always, I thank Mark for being the best executive producer in the world. And I thank you for listening. We'll see you next week.